How can options hedge against tail risk? Have you ever wondered how you can protect your investments from those unexpected market drops? Tail risk is the term for those rare but extreme events that can lead to significant losses. In the world of stock trading and options, managing this risk is essential for safeguarding your portfolio. Options are financial tools that give you the right, but not the obligation, to buy or sell an underlying asset at a predetermined price before a specific date. One of the most effective options for hedging against tail risk is the put option. When you purchase a put option, its value rises if the price of the underlying asset falls. This makes it a handy tool for protection during market downturns. To hedge against tail risk, many traders buy long-dated put options on broad market indices or specific stocks they want to protect. These options are often purchased out of the money, meaning the strike price is below the current market price. This strategy is cost-effective because out-of-the-money puts are generally cheaper than at-the-money or in-the-money options. However, they still provide a safety net if the market takes a sharp downturn. Some traders also use advanced strategies to make their tail risk hedging more efficient. For instance, a time spread collar involves buying long-dated puts while selling short-dated calls. This can help offset the cost of the puts while still offering downside protection. Another common approach is the put spread, where a trader buys one put option and sells another put option with a lower strike price. This reduces the overall cost of the hedge but does limit the potential payout if the market crashes. It's important to note that tail risk hedging is not always straightforward. The cost of purchasing puts can be high, especially when market volatility increases. Traders must carefully weigh the trade-off between cost and the level of protection they desire. Some may opt to hedge only against the most extreme losses, such as declines of 20% or more, by buying puts with strikes significantly below the current market price. Others might combine various strategies to create a more cost-effective hedge. In practice, managing tail risk with options requires ongoing attention and a solid understanding of the risks involved. Traders need to monitor market conditions, adjust their hedges as necessary, and stay aware of how changes in volatility can impact the cost and effectiveness of their strategies. For larger portfolios, such as those managed by pension funds or hedge funds, tail risk hedging often involves more complex strategies and dedicated teams focused on derivatives. These teams might utilize a mix of options, futures, and other instruments to build a robust defense against extreme market events. In summary, using options, particularly put options, is a powerful way to hedge against tail risk in stock trading. By carefully selecting strike prices, expiration dates, and combining different options strategies, traders can protect their portfolios from severe downturns while managing costs effectively. This approach is a key component of risk management for both individual investors and larger institutions.